What's up, folks? It's Eric from Option Edge, and today's video I want to show you how we can get a trading edge by using historical volatility numbers versus implied volatility numbers. So here is a nice little chart supplied by tastytrade. You can see we have a couple different stocks here, the name of the stock, the sector, and we have implied volatility here. And then we have the historical volatility of the last 30 days. And then basically this column here, IVHV 30-day difference. It's subtracting the two numbers implied minus historical volatility. And then here you can see we've ranked the largest differences from top to bottom, with the largest difference being Moderna. And then over here we have the IV rank. So this chart is a couple days old, so there's been some moves since, but out of all of these I want to look at T-Mobile. Okay, so T-Mobile has a IV rank of 17%. So I want to take you to ivolatility.com. Let's go there. All right, we're in iVolatility live. This shows us the historical volatility, which is in orange here for the last 30 days, and then the forward-looking IV30, or the implied volatility for the next 30 days, in green. One of the reasons why I picked T-Mobile or TMUS was a lot of these, so I looked at a lot of these names, they have earnings events, a lot of them, so that's one of the reasons why implied volatility is so pronounced, and I don't really want to make any earnings bets, but T-Mobile is one of the stocks that has a stark difference between the implied volatility and the historical volatility. So what is the significance of this is, well, basically, so it means realized vol is very low, but the forward-looking volatility is actually quite high. So this gives us, possibly an edge where at the moment, volatility seems to be overpriced based on the historical volatility. And obviously, since this is forward-looking, we can't predict the future, but this is the best we can do when comparing to historical vol. And another reason why I chose T-Mobile is because the backtest for a neutral strategy works very well. So let's take a look at that backtest. So here's the backtest. So we're looking at, let's take a look at the strategy. We're looking at a 20 delta strangle, so selling the put, selling the call with a 42-day expiry. And the reason why 45 days is the sweet spot when it comes to selling strangles. And the other criteria we have is we're closing at gains above 50 and after 15 trading days, or basically 3 weeks. And the idea behind that is we don't want our gamma risks to increase, but let's just increase this one more week and see if that gives us a better return historically. I think that's a slight uptick higher, possibly. Now let's look at the trade itself. Okay. All right, so we're in tastytrade with T-Mobile here populated. So nonetheless, here's the options chain. So we want to pick options that are closest to 45 days till expiry, and that's what we've done here. And you can see we're selling a 21 delta put, very close to 20, and then we're above selling a call at 18, which is the closest to 20 delta. And you can see that we receive a credit of 2 and 5 cents basically. And what's interesting about this is the P50, or the probability of achieving 50% gain during the life cycle, during the duration that this trade is on, is 95%. So that's really good. And it's much larger than the 66 probability of profit, which just states what is the likelihood of us profiting a single cent at expiration. It does eat up a fair amount of buying power here, so it's about almost over 2,400. But our beta weighted delta is virtually neutral. Here our delta for the trade is 3. Another interesting stat is the CVAR, which basically is a statistic for takes the mean of the 5, I believe some of the worst trades, the 5% of the worst trades, it takes the mean loss, the average loss of those trades, and gives you the average loss there. So it in a way it gives you an idea of what has happened in the past. So overall, I think this is an interesting trade. All right, so we're out of my brokerage account and we're back in Ivol live, and I have TLT populated with the IV30 and the implied volatility for the next 30 days. And you can see that we have a reverse scenario where the historical vol is higher than what the market is projecting for implied volatility. So this would be a situation where we're now seeing that premium is actually cheaper compared to the historical vol. So this could be a good time to get long. So the main concept is when we're looking at these charts, we want to sell volatility that is relatively high compared to historical volatility. And then we want to buy volatility when it is cheaper compared to historical volatility. And that's sort of how you can be a smarter options seller and buyer.